There are two crucial points I want to highlight. Firstly, there will be a delay in interest rate cuts for this year. Secondly, the Federal Reserve is initiating discussions about reintroducing accommodative monetary policies. Let me provide you with a summary of the recent developments. The Federal Reserve has released the minutes from their latest meeting, shedding light on their discussions held behind closed doors. I'll simplify this for you. Essentially, the Federal Reserve has three options regarding interest rates. They can opt to cut rates, maintain the status quo with no changes, or increase rates. All right, let's address the straightforward part first. The word on the street suggests that the Federal Reserve's upcoming action will involve increasing interest rates. This viewpoint was recently shared by former Treasury Secretary Lawrence Summers. Drawing parallels to the 1990s, Summers highlighted how the Fed initially lowered interest rates before ultimately transitioning to rate hikes. He expressed concern that if inflation gains momentum once again, history may repeat itself. Summers made these remarks during an appearance on Bloomberg, where he mentioned a 15% probability of the Federal Reserve opting for an interest rate hike. As for how he arrived at this percentage, he admitted it was a subjective estimate. Let's keep it honest here. So here's the scoop. While some voices speculate, my take is that the Federal Reserve won't be opting for interest rate hikes next. Their trajectory seems to be pointing downward from here. According to the Federal Reserve minutes, officials have reached a consensus that interest rates likely peaked. This declaration is quite bold, being stated officially on the record. In my view, we're currently at the peak of 5.5%. There will likely be a pause, which we're currently experiencing, followed by interest rate cuts. Furthermore, I firmly believe that any interest rate increase by the Federal Reserve, even if marginal, would spell disaster. This move could have catastrophic repercussions for commercial real estate and would also strain the federal government's budgets. Additionally, such a move would pose significant challenges for the residential real estate market, albeit not as severe as for commercial real estate. It would also have adverse effects on financial markets. I want to emphasize this point for clarity. Even a modest quarter-point increase in interest rates would not just be a minor inconvenience. It would be disastrous. Why? Because any increase by the Federal Reserve would signal a prolonged period of elevated interest rates. To illustrate, the current prevailing fear is being trapped in a high interest rate environment for an extended duration. However, raising rates further would exacerbate this situation, prolonging the period of high interest rates. This would introduce a major curveball, leading to a rapid deterioration of conditions. So, regarding the first option, it's unlikely that the Federal Reserve will pursue that route. How could they? Now let's turn to the second option, interest rate cuts. However, this isn't on the agenda for the upcoming Federal Reserve meeting scheduled for March 20th, and here's the reasoning behind it. During a press conference, Chair Jay Powell explicitly stated that such a move is not on the table. Furthermore, there's no indication of any discrepancy in the Federal Reserve minutes. To elaborate, for the Federal Reserve to consider cutting interest rates, Chair Powell emphasized the necessity for additional evidence indicating a decline in inflation. He articulated the need for several more positive inflation reports to demonstrate that inflation is firmly on track to reach the targeted 2% before contemplating any interest rate reductions. Powell mentioned, and I quote, "I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting." In my previous Federal Reserve video, I shared a clip of him making this statement, allowing you to witness it firsthand. Following Paul's remarks, we received the January inflation reports, which unfortunately showed higher than expected inflation rates. Consequently, it's highly improbable that an interest rate cut will occur in March, and the market is gradually acknowledging this reality. Consider the data from the CMA Fed Watch tool. 1 month ago, the probability of an interest rate cut at the March 20th meeting stood at 47%, which was relatively high. Presently, this probability has plummeted to 6.5%. However, in my opinion, even this 6.5% chance seems excessively elevated. Bears firmly believe it should be less than 1%, ideally close to 0%. I'm allowing for a slight margin of possibility, just in case an unforeseen event occurs before March 20th, like the impact of an asteroid or similar unlikely occurrences. Now, let's shift our attention to the probabilities for the meeting scheduled on May 1st. which is not too far away considering February is nearly over, leaving roughly 2 months until then. Approximately a month ago, the likelihood of the Federal Reserve implementing interest rate cuts by May 1st was an astonishing 90%. Currently, this probability has decreased to 32%. Yet, I still believe it's somewhat inflated. Looking ahead, there's also a meeting in June, but let's jump ahead to July. 1 month ago, the odds of an interest rate cut by July were staggering, reaching 90.9%. Presently, this probability has declined to around 88%. Although there's been a decline in expectations, they still remain notably high, indicating the market's optimism towards potential rate cuts occurring sooner rather than later. Listen, according to the Federal Reserve's summary of economic projections, they foresee 3 interest rate cuts happening this year. However, they haven't specified when this process will commence. As we analyze the clues, it seems increasingly unlikely that rate cuts will occur in March and probably not in May either. Consequently, we're looking at a period of elevated interest rates for the foreseeable future. Once the market caught wind of this realization, interest rates on government debt began to climb, with the 10-year yield, in my opinion, being the most significant indicator, currently standing at 4.3% again. The fluctuations in mortgage interest rates are closely tied to this situation, which is why the 3-year fixed rate has climbed back above 7% currently. Consequently, prospective home buyers searching in the residential real estate market are finding no respite in mortgage interest rates. The consensus is that mortgage rates will likely hover in the range of 5 to 6% throughout this year. Although this is anticipated mainly for the latter half of 2024, now here's the Federal Reserve's strategy, and I'd appreciate your thoughts on it. They're opting to temporarily pause their actions, which is what we're currently experiencing. Their preference is to defer interest rate cuts until later, opting for a cautious approach. If subsequent data suggests they began the process too late, they retain the option to accelerate interest rate cuts to compensate for any initial delays. It's akin to what occurred when they found themselves needing to commence interest rate hikes. They realized they should have initiated the process earlier, and to compensate, they began raising rates more rapidly. Initially, they incrementally increased rates by 0.25% at each meeting, but then escalated to 0.5% and eventually to 0.75% per meeting. This same principle applies if they approach interest rate cuts with a mindset of having waited too long to commence. In such a scenario, they might opt to counterbalance this delay by implementing more substantial interest rate reductions at each meeting. Let's conclude with a rather concerning aspect: the Federal Reserve's actions during the pandemic. They implemented an excessive amount of money printing, injecting trillions of dollars into the economic system, which in turn contributed to inflation. This method is commonly referred to as quantitative easing. Now, in an attempt to rectify this situation, the Federal Reserve has been engaging in a process known as quantitative tightening, essentially the opposite of money printing. They've been withdrawing funds from the system up to $95 billion per month. However, there's discussion about reducing this amount, indicating a shift in their approach. They may not be as aggressive in combating inflation, essentially easing up on their efforts. During their March meeting, the Federal Reserve will convene to deliberate on their approach to this matter. The forthcoming Fed minutes will provide insights into their discussions behind closed doors, offering a glimpse into their game plan regarding money printing. Ultimately, the Federal Reserve will cease quantitative tightening entirely, reverting back to money printing. This transition is inevitable. It's merely a question of when. I anticipate that they won't initiate the money printing process until 2025. Curiously, they're likely to commence with interest rate cuts before proceeding to implement money printing once again. In my view, we've discussed this extensively, and it's poised to exacerbate the inflationary situation, taking it from bad to worse. I'm already contemplating the repercussions this will have on the housing market. Just envision what will unfold when they begin slashing interest rate and initiating money printing. Initially, they'll likely inject hundreds of billions of dollars into the economy, eventually escalating to trillions. The impact on home prices is bound to be staggering. Well, that's the current state of affairs. And frankly, the Federal Reserve officials aren't exactly doing us any favors. In fact, they're exacerbating the situation and making it increasingly challenging. I'm confident I'm not alone in recognizing this. I simply want to ensure you're well informed and educated about what's happening. The Federal Reserve is well aware that we, the people, are not oblivious to their actions. This concerns me for two main reasons, both stemming from inflation. Firstly, inflation worsens wealth inequality, and secondly, it renders everything less affordable. It's widely acknowledged that wage growth isn't keeping pace with the rising cost of living, expenses, and inflation. This leads to a scenario where basic necessities like food, housing, healthcare, insurance, and transportation become increasingly unaffordable. I understand the struggle. I've been there. Let's hope the Federal Reserve makes sound decisions with monetary policy, but only time will tell. Please subscribe. Thanks for watching. Until next time.